Hi everyone, we're gonna get started. Happy Thursday, July 30th. We are at the end of the month. So today, I'm going to go over a quick presentation for you guys regarding the escrow process. I'm gonna take this off so I can speak a little better and you guys can hear me. Just don't nobody getting me 6 feet close. Okay, so I'm gonna go through the escrow process. What happens after the lending team pre-approves your buyer? And what happens in that 4-week closing piece? Escrows right now are taking a little longer than normal because we're in an odd situation. Some banks have half of their companies working from home. So normally an escrow takes 30 days, and this is what the process looks like. You can create a checklist or request one from our team so that we can send it on over and you know what to follow. The first week after you get your offer accepted, they're gonna ask for your EMD. That's your earnest money deposit from the buyer. This earnest money deposit is in addition to the signed contract, getting your offer accepted by the seller. It's a good faith deposit to escrow, the neutral third party that goes ahead and handles the money and make sure everybody does what the contract says. This is part of your down payment. That's a common question. Another thing that happens your first week is your appraisal gets ordered. That is one of the contingency pieces. Your appraisal is ordered, and it is to confirm the value that you have gotten your buyer into contract for. Your inspection is also ordered. Your inspection is a couple $100. It's like the doctor that goes to the home and tells you the good, the bad, and the ugly. And at that point, your inspection is not required, it's recommended. Your appraisal, on the other hand, is required. Why is it required? Because it confirms the value that the bank is trying to get for the home.
Is it EMD required as well?
Yes, your earnest money deposit is always required, and that's set by you guys placing the number on the contract. So you could put as low as $500. I've seen deposits as high as $25,000. Okay. Next, we have our disclosures. The bank then orders the disclosures for the borrower, and it's your initial loan estimate of all the numbers in the transaction. We send it to the borrower, they review, we're in agreement, the numbers are the same as what we previously discussed, and then your rate is locked. We lock the interest rate for a certain amount of days. It could be 15 days, it could be 30 days, 60 days, sometimes 120 days for new construction. When you lock in that rate though, you're guaranteed the rate. It doesn't matter if rates go down, if rates go up, you're automatically locked into that interest rate. If you extend after that rate expires, there is a cost. Depending on the market and the bank, it could be $30 per month, or it could be as expensive as $50 or $60, $70 per month if you have a high balance loan amount. So be careful to always close, and it's a rush when escrow started and the rate is locked because the paperwork needs to get back to the lending team as soon as possible so they can proceed with the loan. No time is lost then. Then the loan is in processing. It's processed and sent to the underwriter. Once it's sent to the underwriter, everything is submitted to the bank for loan approval. That's the next contingency piece, the second big milestone in the transaction. Okay, so now we're in week 2. Actually, I'll take any questions over week 1 items. Any questions?
Yeah, so for the inspection, we schedule that the first week?
Yes, after your offer is accepted and your deposit is given,
Okay.
you go ahead and schedule your inspection with your inspector so that they could go out to the home and do their thing.
But it's okay if they can't take care of it a week, right?
That's okay. You can do it. Like I said, the inspection's not required. It's recommended. So you could really do it the last day. But most agents like to do it ahead of time because that's a place where you can negotiate and ask the seller for some money or some repairs. Because you can ask for closing costs. You can ask for, that's right, Jesse, you can ask for closing costs, you can ask for repairs. The visual eye might not see the termites behind the wall or the roof that has a leak in it, right? Any other questions?
This is when you do your termite as well?
Yes, that's correct. If the contract states that there has to be a termite inspection or that's right, a termite inspection, then a termite inspection report has to be given to the lender. All Section 1 items have to be done. Section 1 means structural items, okay? Now, if a waiver is signed in the contract when you submit the offer or open escrow, a termite inspection is not required. So that's an important piece you want to look at. Some homes enact them and have septic tanks. You might need a septic certification in that point, right? There's other items that come across where you'll need an extra certification or inspection of some sort. Good point, Paul. Go ahead.
If the water, if there's water damage, that's included in the inspection report?
The inspector will
If
see.
there's somebody, you know,
Yes, the inspector will see if there's any mold or rot, wood rot behind that based on the water damage, or if it's just a stain. Mhm.
the termite has to be done, right, before you can continue?
Yes, we will definitely need a termite inspection or a waiver, one of the two things.
So termite clearance, right?
That's right, yeah. If any Section 1 items are needing to be repaired, they have to be cleared. And that's what you mean by clearance, where they go back out and do the work and repair all Section 1 items. So it is required. Mhm. Yes.
So the appraisal is first, obviously, right, to find out what's going on and to value the property, right?
Right.
And anything that that appraiser come out, sees that, obviously we disclose that information, and then whoever the agent is based on that information, if that's the frame time when he has the chance to either negotiate anything that he thinks that it needs to be.
Yes, so the appraiser has conditions.
Right.
The conditions are basically the following. They're basic items to make it health and safety friendly for the family that's moving in. They're gonna wanna see your water heater double strap, one carbon monoxide detector in the home, a smoke detector in every home. We're going to also need a gas and safety shutoff valve. FHA always asks for the chip paint around the eaves to be scraped and to be painted, right? So conventional doesn't really ask for that kind of stuff. If there's security bars on the homes, a lot of homes in Pacoima have them. They have to have a safety latch so that they can access from the inside out in case there's a fire. So things of that nature. So the appraiser is going to call that all that out, right? And normally, even if the house is old or a little beat up, you can still finance FHA. A lot of realtors don't accept FHA because they think that the home might not qualify. We've seen a bunch of homes qualify FHA even if they're beat up and old. As long as there's no holes in the wall, no exposed wiring, it's health and safety code is up to date based on what I just said, then you're going to be good to go.
Eric, you said based on the FHA 203K loan?
Yes, an FHA 203K loan is a loan for just like an FHA, but for a home that needs repairs. At that point, you ask the bank for more money to fix the home and they use a projected value. It's about a 4-month escrow and you involve an inspector from the city and a contractor so that way they can work in a team and upgrade the home. You have to be a first-time home buyer, just like FHA, but that's how the product works.
3.5 down?
3.5% down, that's right.
So you can use that for a flip.
If you're a first-time home buyer, technically, yes.
But you can't sell a home, right?
You can, it's still FHA, so you can sell after. They would just need an appraisal before, and when you're done repairing it at the very end. That's how the process
You have to wait
works.
6 months, or you can sell it right away? 7 months?
Yes, 7 months because you have to make at least 6 mortgage payments.
Oh.
Okay. Moving on to week 2. So these are the main meat and potatoes of things that happen in week 2. We will get your appraisal back, confirming the value of the home. There are two big milestones in the transaction after you open escrow: your loan approval and your appraisal. Now, what does that mean? It means your loan is approved and it's almost a guarantee to lend. You just need these 4 or 5 items sent back to the underwriter so that they can check them off their box. Some of the items might be an updated pay stub, proof of a payment for a liability, maybe a recent mortgage statement or bank statement. It could be a credit report supplement. Another milestone is your appraisal to be back. Once your appraisal is returned and the value is confirmed for what you're in escrow for, then you can remove your appraisal contingency. Once you're moving your loan approval contingency because your loan is approved and you've spoken to your loan officer, he or she said your loan's approved, you can remove that contingency in writing, and your appraisal's back. Those two contingencies basically put the borrower's deposit at risk. However, you're almost a guaranteed close of a transaction. And you remove these contingencies because they're part of the original contract that you started with. In that contract, if you don't adjust the contingency dates, an appraisal contingency is normally 17 days per the contract. A loan approval contingency is 21 days. So some realtors and listing agents cut those times shorter so that way the escrow just moves along faster. If there's no contingency dates in the contract, then those are what's agreed upon. So week 2 appraisal's back, your loan is approved. We start working on loan conditions and send those conditions back to the underwriter. Week 3, one piece that I missed on week 2 is that we also give a second loan estimate as part of your disclosures. So the borrower gets 3 or 4 estimates throughout the transaction so that they constantly see their fees change and adjust.
You lock the rate at the first.
And the rate lock. That's right. Because the market is so volatile right now, it's just hard to pinpoint where the rates are better, so we're always locking in advance. Week 3, we're gonna get what's called your closing disclosure out. These are the final numbers in a transaction. When your closing disclosure is out, you have to wait by law 3 days before you sign loan documents.
This is not CD, right?
This is your closing, yes, it's CD. This is what's called CD, closing disclosure. Now on a refinance, when you get the CD out, you do have to wait 6 days because it's 3 days as a cool-off period and another 3 days for a CD period. The cool-off period comes after you sign loan documents, so that process is a little longer to close a refinance. But for a purchase, it's 3 days after the CD is issued to the consumer. The borrower acknowledges, the conditions are reviewed. If there's a second submission of conditions to the underwriter, the clear to close is then issued by the bank. And that means you're out of the underwriting department and into the closing table. When you're into the closing table, then you're gonna be issued loan documents. Did you have a question, Paul?
If you elaborate more on the TRID.
The truth in lending, yes.
The 3 days and the 3 days after.
Okay, so there is what's called the right of rescission. A law passed several years ago in the lending world where we changed from a HUD-1 to a closing disclosure and a GFE, which is a good faith estimate, to a loan estimate. Those terms of those documents are now obsolete. They're old. So we now work with a loan estimate and a closing disclosure. The rule when these documents came into effect states that you have to have a TRID disclosure that's signed called a closing disclosure. Once you sign it, you cannot close a mortgage loan until 3 days have passed. On a purchase, it's on the 3rd day, and on a refinance, it's on the 4th day. So technically, before you could have signed loan documents today and funded your loan tomorrow, that is not the case anymore. There's a cool-off period. So this 3-day period happens after the closing disclosure signed. For refinances, it happens 3 days after closing disclosure signed, and when you sign loan documents, it's 3 days after that. It's a cool-off period. So that's basically the rule that is now into effect. Mhm. All right, week 4, we get the loans documents signed. You get together with a public notary in your home, in the lender's office, at Escrow's office. Pretty much you can set that up wherever you guys want. So if Escrow's pinpointing you guys and putting their hand on your neck saying, come to our office, technically you can have them go to you, even in this COVID situation. The borrower and the notary are the only ones that need to be present. Our borrower has to have a valid ID and just ready to sign 90 to 100 pages of loan documents. So loan documents include things such as your closing disclosure, your deed, your note of the loan, which is your agreement and contract of your 30-year mortgage. And it includes acts and laws, whether you have an FHA loan or a conventional loan. Okay. Final funds are sent from the borrower after loan documents are signed, the same day or the day after. Then funding takes place. Remember, if it's a refinance, 3 days after the loan docs are signed. If it's a purchase, as long as the CD has been signed, 3 days have passed, you're still good to still fund. Once funding takes place, recording always happens the day after funding. When you hear the term special recording, that means that they're trying to record the same day the loan funds. For example, we fund the loan today. The natural process is for the County of Los Angeles to record the day after, which is tomorrow, Friday the 31st. However, if funding is trying to get a special recording, after funding is done, our borrower or buyer has to go to the county recorder's office, stand in line with the title officer, and record himself or herself. That's called a special recording. It helps get the house 24 hours earlier. Why is that important? Because if you close on a Friday, you won't be able to record until Monday. So it just speeds up the process in getting your house a little bit sooner. Go ahead.
Are you allowing special recordings right now with the whole COVID?
That's a good question. Right now, special recordings are on hold because the county recorder's office is closed for the public. So unfortunately, no special recordings are taking place. We expect to get it out of this funk pretty soon.
I also hear a lot of agents always lie to their clients about funding and recording. So I want to talk about that.
Okay, let's go ahead and talk about that. Go ahead.
Funding is not recording. So do not tell your customers that funding is their closing, recording is their closing. Just because I've had wires pull that funding, and I've made the mistake of like celebrating too fast, and then all of a sudden it's like, oh, nothing.
Yes, that's a good point.
All of a sudden you get stuck. So it's just like, don't get into the habit of telling customers that the funding is a closing. Recording is a closing. You know what I'm saying? Yes,
recording is the closing. That's right, Jesse. Thank you for sharing. It's a very important piece. Funding does not mean you closed. Anything can happen that would cause the transaction to still close, even if it's in 24 hours. We've seen it in the past. Guys, life happens. So it's not closing. Closing is when you record, and after recording, escrow has permission to disperse checks. And sometimes even after recording, they will hold on to your money if there's a situation not fixed. So make sure you get your checklist done before recording. That includes all of your seller's documents, buyer's documents. There will always be disclosures needed until you record your transaction. After that, we're done, right? One more piece. We're going to talk about the loan products. Let's talk about loan products. And what's the difference? This whole FHA, VA, 203K, TDAP, so on and so forth. So today we're gonna focus on two loan products. In reality, there is always gonna be an infinite amount of loan products because the market's always gonna introduce and take out one loan product and put another one in. Those kinds of loans are more down payment assistance geared towards low-income housing. We do live in the San Fernando Valley and in the area of Los Angeles where prices are a little higher. The average median price is around $620,000 to $630,000. So the main products that have been around for over 20 or 30 years are your government loans that are set from your housing agencies the government owns. Fannie Mae and Freddie Mac. They set the rules for lending. And each bank takes those rules and either gives them out to their consumers so that the borrowers can buy or refinance, or they put something called an overlay, an extra rule saying we're gonna charge a little bit more, or we're gonna just ask for a little bit of a higher credit score. So we work with all kinds of banks. The only difference is, obviously, if you have your ducks in a row with great credit, great income, a great down payment, you're gonna have the best FICO score. If you have a credit score that just barely qualifies, you better believe we'll still get your loan done because a 620 is a 620, but you're gonna get a little bit of a higher interest rate and the process might not be the same. So your main products that buyers buy with, about 93% of the loan products that are used out there are FHA and conventional. What is the difference between the two? FHA, you can only get one FHA loan at a time in your credit report period, and it has to be your primary residence. Now, no, they're not gonna come and knock on your door and say, hey, are you still living in the home? But just don't miss that mortgage payment because they're gonna start calling you and finding out what's up with this payment. So an FHA loan is an abbreviation for Federal Housing Administration. A conventional loan has a set of rules for conventional products, and their down payment starts a little bit higher at 5%. The only difference is for a conventional loan, you can get up to 15 conventional loans on your credit report. After that, you have to start using hard money to buy property, or you're gonna have to start buying them cash. FHA, you can only have one. Go ahead, David.
Recently, we had seen where with Ana Marquez, she was going to move 100 miles away so she could do another FHA loan.
Yes.
Is there any other scenarios like that where you could get another
Yes.
FHA?
So that's a very good point. In her case, there is a rule under FHA that says if you're moving over 100 miles away, you can still use the FHA loan, but you have to show proof of reason. And in her situation, she was moving much closer to where she worked versus driving 10 miles versus driving 60 miles. So the difference was significant. She also had one other thing, which is another requirement for FHA. You need 25% equity in that home. And she had about 35% equity. So that was an important piece for her. So FHA doesn't say you cannot use it if you already own homes. You can have 2 or 3 conventional loans and homes as investment properties and still buy FHA as a primary residence. Let me give you an example. Let's say I'm buying 1 or 2 or 3 or 4 properties in Palmdale. Every year I buy with 20% down a $200,000 property. And then after 3 years, there's 4 properties in my schedule of real estate, all worth $200,000 each. The FHA loan allows me to buy up to $765,000 of a loan amount. It's like $765,500 or so. So I can technically buy a property of about $780 or $790 minus my 3.5% down payment, so my loan amount still qualifies. If I find that home, that dream home with 3.5 down for that price, I can still buy that home with 3.5 down and not have to buy 20% down like I did with my investment homes in the conventional. Does that explanation make sense?
Yes.
Okay. So it's a way of using the system to your advantage. We're not breaking the rules. We're just using the system, right? to our advantage. Now we're gonna move on to details. Like I said, we're focusing on FHA and conventional because most of the mortgage loans and purchasers use these products. You still have your down payment assistance, which we're looking into getting a line of. The only difference is your rate is a little bit higher and you cannot purchase as much of a purchase. That means that if I use 57% of an income to qualify a buyer for down payment assistance, I have to use 40 or 45%. So the purchase goes down. The reason is because that's for lower income. And then you also have your hard money loans, which means 20% down, no credit questions, no income questions. We will finance anything, but they're going to charge you a 7 or 8% interest rate, and they'll still get you that money to buy that house. It might have a prepayment penalty of 24 months, which is 2 years, or you might have to pay it back in 2 years. Between now and then, your game plan would be to refinance or work on your situation to get out of that loan, right?
When are you not required to do an appraisal?
There is an appraisal waiver with a bank called UWM, United Wholesale Mortgage. And we've seen appraisal waivers when a borrower has 20% equity on a refinance or 20% of a down payment. And then an appraisal waiver is accepted. We can check the address for you and automatically it will tell us. We just need the loan amount and the address, and that'll give us an appraisal waiver or not. Yeah. We'll send the link out actually. That's a very good point.
Okay, and if you could also send a link to the FHA approved condo, that'd be great.
Okay, of course. Of course. Okay. So let's talk about credit. There are 3 pillars to the pre-approval process. Credit is your first pillar. Income is your second pillar, and down payment is your 3rd pillar. If you kick butt in these 3, you're gonna get financing anywhere you go, okay? So credit with FHA requires a 620 credit score and above. 620. Before COVID, we had 580 to 619. For now, it's 620. In reality, it's not that hard to get there. As long as you pay your debts on time, even if you have a couple of collections, you can still have a high 600 credit score. So 620 and above. Conventional requires a 640 and above. So there's a difference there by 20 points, right? The credit history for FHA, if you filed Chapter 7 bankruptcy, which is complete liquidation, you can buy 2 years after that with an FHA loan. But for a conventional loan, you have to wait a total of 4 years, regardless. Now, for a foreclosure on go ahead.
What kind of bankruptcy? Is that 2, right?
Yes. Now, Chapter 13 bankruptcy, which is restructured debt, FHA allows you to buy after 1 year. Credit, conventional, requires a total of 4 years waiting period regardless. Foreclosures are next topic, yeah.
Any exceptions?
There's no exceptions, unfortunately, yeah. So the best route is to have borrowers wait and go FHA even if they have to pay mortgage insurance and just refinance after they've been there for a while. Yeah, that's usually the best route and it works. Foreclosures. You have to wait 3 years for FHA and you have to wait 7 years for conventional. So you can buy your first house after 3 years, but if you want to start getting investment properties or a conventional loan, you got to wait 7 years after foreclosure. So you can wait, you can buy your primary residence 3 years after you get a foreclosure and lose a house, but you cannot invest in real estate and get a conventional loan until you have a 7-year waiting period. To buy an investment, okay, that's our next piece. An FHA loan, you always need a 2-year history for income, regardless. 2 years of taxes, all the time. There's no exceptions, no ways around it. Self-employed, W-2, whatever the case may be, you need 2 years of work history. if a borrower is W-2 and works for a company, we don't necessarily need to show their tax returns. We can just show their pay stubs for the last 30 days, their W-2s for the last 2 years, and then run a DU, which is a desktop underwriter from Fannie Mae, and it accepts it or rejects it, telling us, yes, you can only use W-2s, or no, you need taxes for this borrower. How they determine that, I don't know, but that thing tells us what it is, and that's what the banks honor. Your income for conventional, why did I put optional? Because it could be 1 year or it could be 2 years. The only way it would be 1 year is if you have a credit score above 700, a debt to income ratio at 45% or lower, and you get a DU or an LP approval. It's normally an LP approval. That's the same credit analyzer as Fannie Mae, but for Freddie Mac. And as long as that LP loan prospector approves our loan, it's going to say 1 year of tax return acceptable. Why would we want that in some cases? Let's say you're self-employed and you make $100,000 a year, but you report $20,000 in profit every year. We all know Uncle Sam, somebody like that does that. Now, you want to buy a house. You go with a conventional loan to try to qualify with 1 year of tax return. And if you have a 720 or 740 credit score because you take care of your credit score so much, Cynthia, can you give me some water, please? Thank you. Then what happens is if you run this loan prospector and it approves you for 1 year, then you can file tax returns for the previous year just to qualify for the mortgage, purchase your property, and continue business as usual once you're done being an owner of the home. Y'all follow?
Yes.
So that way you don't have to report 2 years of taxes with FHA and buy. Thank you so much. And pay a bunch of money in income tax. For example, reporting $100,000 to buy a $600,000 property, you're going to have to buy like $25,000 in income tax. That's what you have to pay the IRS. It's the price you have to pay to be an owner. You could, that's a CPA question, but if you do have a corporation, you could probably pay $15,000 in income tax versus $25,000. So there are ways around it. As long as you consult your CPA and adjust accordingly, you can definitely work around that. But you still have to pay a sum amount, regardless. Yeah,
Regardless, but
a good amount. Yeah.
Are rates higher on a conventional or just?
That's a good question. That's our next piece here. Okay, so rates for FHA. Rates for FHA are always going to be better than conventional, all the time. Only once or twice a year does the market change a little bit and conventional rates are better. Right now, FHA rates are anywhere from 2.5 to 3.1%. I've never seen that in this industry, and I've been doing loans since 2009, 2010.
can you repeat that? What's the rate?
Excuse me. 2.5 if you have a 720 credit score or above, to 3.1 if you have a 640 credit score or above, which is really not a bad deal.
Right.
Patikian and I were looking at the market yesterday. I mean, I'm shocked because I've never seen that before. Rates are kicking butt, 2 point something on a 30-year fix. That means that if 2 years ago you had a buyer that qualified for $500,000 and the rates were 4.5%, right now they probably qualify for $635 because the rates are 2.9%. Go ahead.
You know, I was going to ask you yesterday. I'm going to be purchasing this with an FHA, so I have to pay that mortgage insurance. What if down the line, whenever I've paid enough to go and take that off, but I have such a good rate, am I able to not take any money out and just refinance it to take off the mortgage insurance to keep that rate?
That's a good question, and unfortunately, no. You have to lock at what the market is then and there.
Does it make sense sometimes to just keep the FHA?
It does.
The rate is?
It does. Sometimes people come in here trying to refinance, and even if they have mortgage insurance, they have a low rate. And I tell them, well, your payment is going to go down only $60 because the numbers just don't make sense. And I wouldn't recommend them paying the closing costs, going through the process. The rule on our book at Global Premier Connect is usually To refinance, you gotta save $200 at least. Yeah, then it makes sense. Go ahead.
Can someone refinance and not, get cash out?
Yes, it's called the rate and term refinance. The only other option would be a cash out refinance.
Cash out refinance?
Yes.
And, another question, because people had asked me that question, is if they refinance, do they have to go back to start over again? Like, which means that's what mentality a lot of people.
Yes.
I have to start all the way from the beginning, like if I never make payments.
You do reset the mortgage terms again. So you choose at that.
What about the, I'm sorry.
Mhm.
Okay, it makes sense they have to restart, again with, because they're resetting the whatever, right? But what the problem with some people is they thinking of pay, my original mortgage was 400, right?
Mhm.
Am I going, and they already paid already like 3 years, 3 or 2 years ahead. Am I going to be again back to 400? That's the mentality that I think people get over there.
Yes. Okay, let's talk about that. When you refinance, you have to choose your term for 10 years, 15 years, 20, 25, or 30. Now, if you choose a 15-year mortgage, your rate is a little bit lower than 30 years. That's automatically what it is. But your payment goes up almost double because you cut it in half. Goes up about 65%. Now, if you decide to refinance and eliminate mortgage insurance and you've owned the house for 5 years, you're at year 25 and you're going to get another 30-year mortgage. I'm always going to recommend our homeowners to do that, even if it's extending it for 30 years. Why? Because I care about cash flow for them and their well-being. I don't want to give our consumers a 15-year rate, even if they qualify a 15-year term, and all of a sudden they have a $3,000 or $4,000 payment that they qualify for, but they barely even make any more money for groceries and expenses. I'd rather have them at 30 years, pay a $1,300 payment, be super comfortable, and then if they want to apply more towards the mortgage, there's a mortgage trick. Instead of sending 12 payments a year, send 13 payments. And the 13th payment apply towards principal reduction. The 30-year term will then turn into a 21 or a 22-year term. If a borrower wants to apply more than 13, then they can, and they're just going to pay the house off sooner.
Let me see if I understand this. So they would refinance the loan amount that they actually they own at this point, right? Now,
yes.
Because what I understand from people that they don't know anything, they think that, oh, if I refinance and I don't get cash back, they say that I'm going to start over again on what they own in the beginning, like say 500, right?
Right.
But they right now they only owe 450.
So we'll refi 450.
That exactly.
For 30 years or 25 years or whatever they choose.
Yeah.
That's right. Yeah.
I have some people say
mhm.
that they want to refi after 10 years and they want to put like they want to pay down the loan. They have 100,000 down. Can we do that?
They can do that, yeah. I've had borrowers do that where they apply, 40, 50,000, 100,000, and they just get a cheaper payment.
Do they have to wait until they refi it? Or can they do it anyway?
They can do it then and there or at the close of escrow. But if they do it then and there, their payment will stay the same as what it is now because it's probably a fixed rate. So even if they reduce it by a lot, it won't go down by a lot. But when they refi and adjust the numbers, it'll go to that rate in that term.
Yeah, question.
Go ahead.
Another thing that people have in their mind is, oh, I'm gonna pay. Obviously, they gotta pay, which is the closing cost, right?
Right.
Can that closing cost what is it?
Closing costs?
Closing cost be added to the loan?
It cannot, and that's a good question. When in a refinance, yes. In a purchase, no.
Oh, no, in the refinance.
Okay, yes.
Oh, they can.
The only two closing costs we cannot include in a refinance is going to be any appraisal fee and re-inspection from the appraisal.
Okay.
If the appraisal says, okay, you have to put the water heater double strapped and the gas safety shutoff valve, I charge $100 to come back out, or 150 because that's what they charge. Then you have to pay that fee out of pocket. All the other fees, you could put it into the loan.
Did you have an estimated, or it all depends on your loan amount? Because sometimes they cut off on that stuff. Oh, is it like a big dollar amount?
Oh, that's a good question. A lot of people say 3%, or, well, it's really hard to tell, but For 250, you're looking at about $8,000 or $9,000. For like more than that, usually
No.
closing costs are $10,000 to $15,000. We have an $850,000 purchase right now where the closing costs are $16,100 because August requires 8 months of taxes in their reserve for a closing cost for their impound account. I'm sorry. So those 8 months make the closing costs go up by $4,000 or $5,000.
So not to buy an August. It's a good idea.
Well, if you don't want to make any money, right? No, but yes, good point. February is a month where they only charge 2 months. So in that case, your closing costs for tax, your impound for taxes are going to be like $700 versus, $6,000 in August.
But you're talking about the closing cost or
Yes.
just buying?
The closing cost.
Okay, so
Mhm.
it will be like 10 to 50,000.
Yeah. And in reality, the borrower is always going to have to pay that money sooner or later. It's just asking for it now versus in November when the bank charges them directly. So eventually they have to pay. It's just a matter of when, right? Yeah.
Right.
Being a homeowner is just part of it.
Is it worth it for them to refinance without not getting cash back, but also paying that 10 to 50,000?
Well, it's just a personal decision because what if you're opening a business and need 50,000? What if your daughter's getting
Just
married and
because
you
they
want to?
wanna lower the rate.
Yeah, what if you're retiring and you want to leave the house to your 2 kids, but you want to cash out 150,000 and go to another country and travel the world? Like people are at different stages. So yeah, sometimes people want to cash out and right now the home values are a lot more than 10 years ago. So 10 years ago, if you wanted 100 grand, even if you wanted it, you probably didn't have the equity. But now almost everybody has a ton of equity. So people are selling, people are cashing out because those escrow checks are coming in at 200,000, 300,000 after paying off their mortgage. Right. Did you have a question, David?
I was gonna say, what we said before was to get an idea of the closing cost, it's typically around 2% of the price of the home. So
Right.
that's how we get an idea.
Okay, there you go. Yeah, about 2%. Yeah.
Okay.
Now let's talk about mortgage insurance. Credit. Okay, actually we didn't finish the interest rates. The interest rates for conventional. If you have a kick-ass credit score above 720, we're going to get you like a 2.8 or 2.9% interest rate on a conventional. If your credit score is bad, you're going to get like a 3.7, which honestly is still a really, really, really good rate. Yeah. I'm a lender and I have a 4% or a 4.1 or something like that. So yeah, I need to get up on that. Next is going to be your mortgage insurance. For an FHA loan, your mortgage insurance is always going to be 0.85, and it's going to be for the total loan balance divided by 12 months. Regardless if you put 3.5% down payment or 50% down payment. Go ahead. Yes, so there's an upfront mortgage insurance premium that's part of your closing cost for FHA, but it goes on top of your loan amount. That's how FHA makes their money, and they're able to lend with so low requirements and such a low down payment. Unfortunately, the borrower's loan is going to be higher than their 100% minus 3.5% down payment, but it's part of getting FHA. Yeah. Conventional mortgage insurance is based on your credit score and your down payment. The higher the two, the lower your mortgage insurance. Your mortgage insurance could be half of what it is for FHA, which is 0.41. Or it could be higher than FHA, which is 1.3 or 1.4. Super expensive. I've seen like 1.3 monthly, and the borrower wanted to go conventional because they were interested in a condo and their credit score was just the worst. It was like 630 or something. So the market was bad, and I recommended them to go FHA, but as y'all know, FHA doesn't really finance condos.
So what would that be in dollar amount?
Monthly, let's say you're getting a $350,000 loan.
$300.
Yeah. So 1.25%. Yeah, 364 per month, and then FHA for that same loan amount. Is gonna be 247. Yeah, so it is cheaper for sure. I mean, that's why going conventional, make sure you have your good credit score. Another piece of the conventional down payment section. If you want to invest in real estate, you have to give a 20% down payment to buy. If you don't own a home, you can take advantage of your 3.5% and still buy a house and use it as an investment. Just don't tell me, okay, that you're doing that.
Can you say that again?
Yes, if you want to invest in real estate, remember I mentioned you could get up to 15 loans with a conventional mortgage, but you need 20% down for every investment purchase that you do. If you don't have FHA, you can use that as an option because you have the capability to, and they let you. But if you use it as an investment, just keep it to yourself and leave it at as is.
I heard something like just get the mail sent to that house.
Yeah, or a PO box or something. I mean, there's ways around it, but at the end of the day, if you move into a house that you buy and you have a situation with your neighbor and the cops are involved and something's happening and you're just not comfortable, the bank's not going to force you to live there, right? But they're going to want you to have something to back it up. So, however, there is I believe they even have you sign some type of document at Loan Docs for FHA stating that it's in occupancy statement saying you're going to move in 60 days or something like that. Yeah.
How much is the FHA down payment, interest, not interest?
Our batteries low,
The percentage?
FHA interest rate?
No.
Oh, we're at the end now, thank you.
You know how much is usually people ask me how much is down payment on FHA loan?
3.5% down payment all the time. You can give more if you want, but even if you give 20%, you're not going to get rid of mortgage insurance. I talked about mortgage insurance earlier for a conventional loan. This is a link to get your mortgage insurance priced. If you put your credit score, your loan amount, your purchase, you go to Radian or MGIC, and if you give 20% down on a conventional loan, you're not going to have this mortgage insurance. You're going to only pay what the bank requires you to pay, which is your principal and interest on your payment, your homeowner's insurance, and your real estate taxes by the County of Los Angeles. Does anybody have any questions for me? They just opened up again. That's a very good question. A non-QM loan is where they'd ask for 20% down and they don't verify income and it's an investment purpose loan. So Athos Capital is our lender. They just opened up. We're going to send them a file this week and I'll let you know how it goes, Paul.
Any items that the bank statement?
No, it's called a business purpose loan and it's 20% down. No income, credit score is required. They have regulation for that.
No income,
That's correct. Yeah. So I'll get a presentation ready for us on that product. It's a non-QM.
There's no bank statement loan right now?
I will ask about that. They got rid of them in February, March of this year, but maybe they're coming back.
You have a VOE program.
5% down conventional. Borrower has to be VOE verified. Yeah.
You have a
W-2 VOE verified.
tax loan?
Yes, if it's a W-2 and pay stubs, we can qualify the borrower that way,
Without tax.
without taxes, conventional only.
I-10 buyers.
We don't have I-10 right now. Yeah, that's a big one. Tax identification number, we wish we did, but not at the moment.
Can you go back to stage 2?
This one? Week 1 or week 2?
2. No, it's only to calculate. I'll write it down. 2.
Yeah.
Appraisal. Appraisal back, right?
Right.
And then we have a loan approval.
Now, it's not irregular nowadays to have 3 condition resubmissions. where the underwriter gives us a loan approval, and then we send the conditions back, and then they give us an updated loan approval with, instead of 10 items, 7 items, and then we send them back and they give us another list of 2 items, and there's a back and forth. Why is it uncommon? Because right now underwriters are being scrutinized to underwrite to the T, because a lot of people are losing their job with unemployment and COVID going on. However, there's still a lot of people employed. City workers, there's people that have to maintain the doors open, food that has to be delivered, medical workers, construction workers, business owners. So there's still a lot of people working and employed, but TCs, assistants, realtors, lenders, Ubers, yeah. So the list goes on. So the underwriters are being strict because unemployment has hit like 40 million. So it's not uncommon for there to be a back and forth during your loan approval. So just as a heads up, right? I didn't put that piece in here, but I saw it as a third bullet point. Any final questions?
Are you doing commercial loans?
Yes, we're doing commercial loans starting at 20% down. They look at the debt service ratio, and that's actually our Athos Capital Bank as well. That's starting to finance there.
20% down.
20% down, yeah.
Is it the same rate as a
That's good to know.
residential one?
They started around 6%, so they're a little bit higher, yeah. There's money to be made, so they're.
Are we approved to do SBA?
We are not approved to do SBA, but if you'd like us to look into that, we can most definitely do that.
Yeah, that'd be
Okay.
good, because that's 10% now.
Okay, a small business loan,
Yeah.
small business administration loan. Okay, got it.
Yeah, it's 10% now.
Okay. Cool. Well, guys, Global Premier Connect hosted some pizzas. So thank you guys so much. So make sure you bug us. We are texting you guys regularly, so respond or hit me up directly, and we're here to help and make your life easier. So put us in, coach. Thanks, guys.